Now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. It's, of course, Tuesday. That means John Penn's here this morning, so we're talking a little bit about money. The big topic today is should you let your kids move back home after college? We'll get into that. Why are you laughing? Why are you laughing?
Goes without saying.
All right, there you go. Yeah, there's a lot to that, actually. So anyway, this morning, retail sales data. We got a lot of economic data coming out today. Retail sales being the big number, of course. That makes up 40% of personal consumption expenditures. So what happens with retail sales will impact this GDP, kind of this quarter two GDP report that's coming out starting in July. Now, interestingly enough, though, analysts have been ratcheting up. Goldman Sachs is now at 3.8% for Q2 GDP. Now, that's a big recovery, of course, from the negative GDP print we had in the first quarter, of course, as we've talked about before. That was all the tariff front running. We had this whole big trade imbalance that was going on because producers were shipping in a lot of goods to get ahead of the tariffs. And then when the tariffs turned out to be no big deal, now they've got all this inventory they've got to liquidate. So now that whole trade imbalance has shifted in the other direction. That's providing a big input into that GDP report. So really, when we get the GDP report, it'll be like big headline number. It'll be great. Like the economy's booming. But you've got to strip out that whole net export part of the equation and look at personal consumption expenditures. Those are likely not going to improve a whole lot. So in fact, if you're looking for anything in that report, it'll be that number in particular to see if it was weaker than even in the first quarter. First quarter was okay, but it was definitely showing some weakening trends. And of course, we'll want to see that because, again, personal consumption expenditures, that's 70% of the GDP equation, roughly. So goes PCE, so goes the economy, and ultimately so goes earnings. Now, speaking of earnings, now that we have this, now look, tariffs are over, right? Those whole big concern we had about tariffs in March and April, it's over. As far as the markets are concerned, it's over. There's no concern about tariffs anymore. That's old news. The debts and deficits, that's old news. All those narratives that we talked about, it's old news. So now we're moving on to something else. And right now it's Iran and Israel, and then it'll be something after this once that calms down. So again, we've talked about before, that's the problem paying attention to narratives. They fit the bill for the moment. And then when the markets no longer agree with those narratives fade into dust. And that's what's been happening as of late. But speaking of fading into dust, earnings estimates are not. And in fact, we had a very sharp downward revision ahead of the Liberation Day tariffs in earnings expectations. A lot of analysts were going, hey, these tariffs are going to be terrible for earnings. They ratcheted down earnings to a large degree. Well, since really the beginning of this month, we've had a massive surge in earnings estimates revisions. And in fact, those revisions are now the highest on record for this year so far. Just a very, very sharp increase, particularly with the S&P 500. So analysts are now much more optimistic, even with the remaining tariffs that are out there. They're going to have no impact virtually on earnings for the S&P 500, according to Wall Street at this point anyway. And that's why now we're starting to see them ratchet up year-end targets for the S&P 500 to 6,500 to 7,000. So again, we're starting to see a really marked reversal of all that concern that we saw back in April for the markets. That's been completely reversed. And we're talking about completely reversed. Retail investors have gone absolutely bananas. We have the largest inflows into penny stocks. Penny stocks are the proxy for retail investors because institutions are not allowed to invest in penny stocks. For a whole variety of reasons. But when you start looking at penny stock volumes, they have absolutely exploded. So in fact, we haven't seen this type of activity in retail investors since they were getting stimmy checks back in 2020, 2021. Where they're all getting the money from, who knows, but they are loaded with cash and they are in hunting bear right now in the markets. And so that's why we've seen big surges in the markets, particularly pre-market. We're seeing most of the action in the overnight markets pre-market. So again, just it's a very interesting dynamic that's setting up right now. But let's talk a little bit about the markets. This is what you need to know before the bell this morning. So markets rallied a little bit yesterday, kind of bouncing off the 20-day moving average. And again, just, we had this big concern over the weekend about Israel, this whole World War III headlines everywhere over the weekend. We expected coming out on Monday, it was like, oof, this is going to be kind of a bad day for the markets. Nope, not at all. Retail investors heavily bought the dip yesterday. You had a nice rally. This morning, futures are pointing a bit lower this morning. Really, news flow hasn't changed much at all over the last 24 hours. I mean, we still have attacks going back and forth between Iran and Israel. So I'm not sure what the excitement was yesterday for the stock market, expecting a quick resolution of this. That was kind of the only explanation. Oil prices fell and stock prices rose, so we saw a big reversal in that fear trade from the weekend. But nothing's changed. And so this morning we're starting to see the market kind of pull back again this morning. Oil's down, oil's up, gold's down. So it's kind of a bifurcated trade this morning. But again, really when we step back from it all, and again, we talk about narratives and we talk about headlines, and it's like, okay, this is why the market's doing this today. It's because of Iran and Israel, or this is doing this today because of what Trump said, whatever. Really, though, the reality is that we've had a very big run here, and the market, while it's trying to still advance here, the bulls are still trying to drive this market higher. They're starting to really struggle to do so. We're starting to see momentum slow down here a bit. We are, kind of running along this 20-day moving average, but the deviation above the 50-day moving average, which is this lower moving average that's still below the 200-day moving average, so we're still technically on a death cross right now for the markets. Got a big gap here for the 50 days, so that's kind of acting like gravity. So that's slowing the ascent of the market here a good bit. Now, because we've had such a very big run, and I need you to pay attention here for just a second, because when we finished up the first quarter, right? So the first quarter was March 31st. Here's April. So we finished up the first quarter with this 10% decline in the market. We then had this big drop off in the very first part of April. So April 6th was the low here for the markets. We've had this massive rally from April the 6th to June the 16th. This is the second quarter for the markets. Now, what's important here is that equity advance has gotten pension funds offside. So there is potentially, and I'm not saying this is an absolute certainty, so just be careful. But as we move into the end of the quarter here, which is just 2 weeks away, we talked about losing stock buybacks here recently. So those started fading out on Monday. The window starts to close for buybacks was this past Monday. That's going to become more aggressive as we go through the next 2 weeks. But as we get into the end of the month, if pension funds are offsides, and it looks like they are right now just from positioning and balancing, that there are offsides in terms of equity exposure versus bonds, because bonds haven't really gone much of anywhere. So equity prices have risen, bond prices really haven't gone anywhere, which gets them to be overweight in their equity position. So we could see some additional selling pressure coming into the market as we get closer to the end of the month. We'll see what happens. But again, there's a couple of reasons just to be a little bit careful about this market right now, just simply from the function. We've gone very far from those April lows. There were a lot of people that were trapped. That retail investors are getting very, very bullish here. And while we've seen a lot of short covering pressure on hedge funds, they're still operating on the defensive side, and CTAs, which are the computerized trading algorithms, their exposure really right now is for more selling rather than buying. So there's some potential as we get over the next couple of weeks. We could see some more choppiness and sloppiness in here. So just be a little careful with your allocations as we get into the end of the month, and then we'll just kind of readjust from there. That's what you need to know before the bell this morning. We'll come back with John Penn, talk about your money. Are dividends and portfolios stable? We'll talk about that. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Declare your financial independence from the mainstream financial media and join us for the next RIA Candid Coffee with Danny Ratliff and Lance Roberts, Saturday, June 28th. Know the enemies of your wealth and fight them on your terms. We'll arm you with the information you need. Register today for the Financial Independence Edition of Candid Coffee, Saturday, June 28th with Ratliff and Roberts at realinvestmentadvice.com. realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. It is, of course, Tuesday. That means John's here.
Good morning.
Good morning. How are you?
I'm good. How are you?
Yeah, I always don't look forward to today.
Awesome. I'm glad to be here. It should be fun.
Only Wednesdays are worse with Danny, so
Oh, well, at least I know where I am on your ranking system.
it's all good.
I appreciate that.
I'm just messing with you. Over the weekend, the boys had a live event here in the Woodlands talking about Social Security and income generation in retirement. And of course, one of the big concerns as you move into retirement and you're collecting Social Security is to make sure that your income doesn't exceed your brackets to where you start getting taxed on your Social Security. Now, I don't know where we are with that particular bill, but Trump's trying to get rid of that. That's one of the, and I think he should. Right. Retirees are already, stressed enough, and Social Security is great. And like 90% of retirees depend almost entirely on, I don't have the exact stats, but it's a very large number.
It's pretty close to 90%, actually. It's a very large piece of their overall income stream.
And there's like 50% of them, that's all they have.
Yeah.
Right. So Social Security is very important. But if you go out and get a job or create other income, taxable income, that could impair your Social Security by taxing you on your benefits. Well, one of the ways you can generate income in retirement is through investing and dividend income. So one of the challenges, and again it's kind of multi-layered, but I want to focus on stability of income. One of the question is creating stable income in retirement, to supplement your Social Security by dividend investing. Now, let me just state right up front, there's nothing wrong with investing for dividends, right? We run a dividend growth model in our shop, and we believe in companies that pay dividends because companies that pay dividends tend to be better stewards of capital when they have to pay that dividend, and dividends get paid out before anything else. So it's an important aspect to your portfolio. Everything we talk about here, there's several negatives to investing for dividends, or I shouldn't say negatives, there's not really negatives, but cautions that you need to be aware of when investing for dividends in your portfolio, particularly if you're dependent on it for income and retirement. So, but when my point is though, is that I certainly encourage you to invest for dividends. It's a very important part of your overall total returns, but there are some risks to it. And we're going to talk about some of the risks you need to be aware of this morning. But when you look at portfolio returns, right, and you're building your own portfolio for retirement, there's three legs to that particular stool that you're looking at. So you have your capital appreciation. Capital appreciation is important because that helps you adjust for inflation. And I'll explain that real quick. But the second leg of the stool is dividends from those stocks. So you have income coming in. And then third is from your bonds. Bonds give you safety of principal and the guaranteed return. So you're going to have an income stream. So again, as we've talked about this before, just using a very simple metric, because it's early in the morning and I'm only a quarter cup into my coffee this morning, so I need easy math. A 50-50 portfolio, if John sits down with you and runs a financial plan and says, okay, you need a 6% return in your portfolio for retirement to make sure you have all your funding needs, et cetera, blah, blah, blah. Well, right now, today, I can go out and I can put 50% of my portfolio in a 30-year treasury and pick up 5%-ish, right? So 5% by 50, that's 2.5% return guaranteed to my portfolio every year. I don't have to worry about that anymore. So 2.5% of that 6 already taken care of. If I build another 50% of my portfolio yielding 3%, we'll just be conservative here, in dividends, that's another 1.5% in my portfolio of income every year from the dividends in my stocks. So now 2.5 plus 1.5, I've already got 4% of my 6 done, period, end of story, done, right? So I'm already in pretty good shape. So January the 1st, when I flip on my light switch for 2026, I already know that 4% of my 6% is taken care of. I don't have to worry about that. So now all I need is a 2% return out of my equity side of my portfolio, which means I need a 4% return in the market, right? So everything's by half because I only have 50% invested in stocks. You with me? Good. So I don't have to. So the point is, I don't have to take a tremendous amount of risk to generate a 6% rate of return. But that's why interest income from bonds is incredibly important. Why dividends from stocks are important. But you have to be careful with the dividend side. So before I go any further, John, just any comments?
Yeah, so kind of what led to this whole conversation this morning is at the event on Saturday, after the event was over, there were a lot of folks, we kind of hung around the room and we're talking about all sorts of questions. And one there were several questions about dividends and how to incorporate them into a portfolio. And somebody asked me, they said, well, John, what do you think? You know, what is your opinion? Do you think, should I think about dividend income from stocks as being stable or fixed? And that's what really led to the conversation. So there was a good conversation around, well, how should you really think about this? And because in my mind, you know, dividends are not fixed. Like a company, dividends, in other words, dividends are not guaranteed.
Right.
A company,
which is one of the risks we're going to get to here in a second.
Just a moment, because the board of directors actually has to declare and approve dividends. It's not always automatic. And I think sometimes as an investor, that's one of the things you can't make that assumption that dividend will always be there.
Right.
Right.
Well, this is the big risk that, or this is the big issue that most investors make.
Yeah.
Is they start chasing stocks with big dividends. Oh, look at this stock; it pays a 9% dividend or whatever it is. Well, if your dividend is outside the realm of what you're getting on a 10-year treasury, that is a function of risk. So in other words, it's, you know, you can get paid a very high interest income coupon payment on a junk bond, but you're getting paid that for a reason, right? Because there's a very high risk that company is about to go bankrupt. So if you have a company that's paying a dividend that is well in excess of what the 10-year treasury is, there's risk there. And you just need to be aware of what that risk is. And the most important aspect, and this is the big risk that as investors you need to be aware of, and particularly if you're building a portfolio of dividend yielding stocks for retirement, is that I just actually went through this probably 2 weeks ago with a gentleman. He sent me his portfolio, and his portfolio is yielding like 8% in dividends. He's like very proud of this. Well, I started running all the credit ratings on the stocks, and he has a lot of embedded risk in his portfolio. He says, I don't care what the price does as long as I get my 8% dividend. Well, the problem with this is this, and we saw this in 2001 and 2, and we saw this in 2008. When the markets were down 50%, during those two periods, you've lost 50% of your capital. Don't care, I'm still getting my 8% yield. The problem is that all the companies cut their dividends by more than 50%. Some of them cut them entirely.
Yeah.
So now your portfolio is down by half. You've lost half your capital, and now you have no dividend income on top of it. That's the risk that you run with when you're collecting higher than market yields. You have to understand what the risk is that you're fine as long as markets are going up and everything is honky-dory, you're in good shape. But again, as investors, and particularly if we're in retirement, is hedging that downside risk of something happening. Because when one of those events happen, and they tend to happen at the worst possible time in your life, not only do you lose half your capital, you also lose all your dividends.
Yeah, you lose the income stream. And, companies they're going to try to do, unfortunately, a company's going to try to do everything they can to keep their dividend in place. I mean, they will let employees go, unfortunately, to try to save on their bottom line, to keep their dividend in place. When they reduce or eliminate their dividend, they're really trying to save themselves there. But there's, another question I get is, well, how soon, if a company does reduce or eliminate their dividend, how soon am I going to know about it as an investor?
Right.
And unfortunately, there's really not a prescribed communication process around this. There isn't necessarily a fixed period of time where the company says, hey, Lance, just letting you know, dividends are out of here. I mean, they typically would announce that on an earnings call, or they make that available in like their SEC Form 8K. You can usually find that under the investor relations area on the company's website. But typically, folks kind of find out about this as the company's actually making the actual declaration.
Right.
Right.
Unfortunately. That's normally the case. But again, stepping this back, there's several things to be paying attention to when you're looking at a company, and you can determine this fairly kind of on your own. When you're looking at a company, and particularly if a company pays a very high dividend yield, it's okay. So first of all, let's classify a couple of things. When you look at a stock and it pays a 9% yield, right? You're not getting a 9% yield. You're getting the cash that it pays out on an annual basis, right? So if I buy, shares of ExxonMobil, I'm going to get $1 worth of dividends every year. And if I buy a share of I'm making numbers up, right? I'm not looking at the data, but just it's an example. But if I buy a share of Procter & Gamble, I'm getting $1 in actual cash paid out every year per share, right? So they're identical. The yields are different because the yield is a function of the cash payout by the price of the stock. It's just a mathematical calculation. You don't get the yield. What you get is the cash payout. So that's what you want to be paying attention to, and we'll talk about why that's the case when we come back from the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Declare your financial independence from the mainstream financial media and join us for the next RIA Candid Coffee with Danny Ratliff and Lance Roberts, Saturday, June 28th. Know the enemies of your wealth and fight them on your terms. We'll arm you with the information you need. Register today for the Financial Independence Edition of Candid Coffee, Saturday, June 28th with Ratliff and Roberts at realinvestmentadvice.com. realinvestmentadvice.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Impossible Foods sets its sight on flexitarians. I qualify as a flexitarian because once in a while I have a salad.
The Real Investment Show podcast.
Is that what it's considered now? They made up a word for this?
Yes.
Those are perfect names because Beyond Meat, yes, it's not meat. And Impossible
Foods?
Yeah, it is impossible.
It's impossible to eat.
I mean,
Same show, your schedule.
Can you imagine sitting around the boardroom at Impossible going, okay, what do we call people that eat a salad every now and then? I have an idea. Occasionalitarians. No, that doesn't work. It's too long. How about flexitarians? God, that's it. We're going with it. Flexitarian.
that guy got a raise. Isn't that
He did.
crazy?
He got a raise for it.
That's genius.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now, with the new and improved Before the Bell report. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So on this table that I've got up, I need the first two columns to the left. Okay. So just talking a little bit about dividends here, the things to kind of look for when you're investing in dividend yielding stocks is important. And as I said, just as we close out the show, you don't get yield. What you get is the cash paid out per share on an annual basis. So if I own 100 shares of two stocks, I will get whatever the payout is per year, per share of that stock, right? That's all I get. The yield is just the mathematical calculation between that payout and the price of the stock. So let me give you two examples here. I'm not going to give you the names of the stocks, because it's not important. But one has a 3% yield, one's got an 8% yield, and we'll talk about the difference here real quick. So the first one, this stock has a 3.5% dividend yield. So you see that there. It says dividend estimates in the first column about halfway down. It says dividend estimate 356. You see that the actual cash flow or the cash per share, right? This is the thing to be looking for, right? How much cash do they have on per share? Because that is what they're going to be using to pay that dividend. So if they don't have a lot of cash on hand per share, that's important. But also look at the next column over where we start talking about debt to, long-term debt to equity, the quick ratio or current ratio, either one. They've got liabilities to pay. And in the event of a bankruptcy, right? They've got to pay their creditors first. Dividends are down the list. So first thing gets paid is the IRS. Second thing gets paid is payroll, then creditors, then stockholders, well, preferred stockholders, and then stockholders at the very bottom. So you're last on the list in terms of a bankruptcy. So making sure that the company doesn't have a tremendous amount of debt is certainly important, because in the event that something goes wrong, you've got issues. Now, let's take a look at this other company, which has an 8% dividend yield. So it's like, so a lot of investors are like, ooh, 8% dividend yield, I'll buy that all day long. I don't even have to get money. I don't have to get a return out of the market. Long as I've got an 8% yield, I'm good. Well, the as long as part is the important thing. Okay, this company's got $3.73 a share of cash on hand per share, right? So not far different than the other company with $4. So hey, it's a good deal. Hold on a second. Look at long-term debt to equity, right? Debt to equity is 15 times, 16 times. So again, you're going to be way down this list, and income for this company is negative. They've got a negative $190 million coming in income on sales of $1 billion. So, what that tells you is that this company has some risk here going forward. And if they are unable to become profitable in terms of generating actual income per share, and this is why they have no PE, because they have no earnings. If they can't get this company turned around and start generating earnings, there's a big risk to that 8% dividend. So again, just understanding some basic analysis will help you kind of navigate when you're selecting stocks. We all gravitate towards these big numbers. And I know a lot of investors, they go on stock screeners and they go, show me all the stocks with the biggest dividend yields, right? And then they start buying those. And there's, you may get away with that for a while, right? But again, the moment that things are the worst is when things get really bad for dividend equity investors that are chasing yield versus chasing fundamentals. In a dividend portfolio, fundamentals are far more important in a dividend equity model than in a growth model, because growth model is all about momentum. So I can buy stocks that have no earnings as long as the price is going up. But if I'm buying and holding a dividend model for the yield, fundamentals are far more important than just about anything else.
Yeah, and there's a number of folks, Lance, that they manage a portfolio of dividend-paying stocks, and they have a couple of I would consider those kind of a high flyer, a little bit more speculation.
Sure.
Right? They've got a couple of those in there, maybe just to enhance the overall return that they're getting from a dividend standpoint, but it's all about balance. They're not putting 25 or 30% of their dollars into a company that's maybe paying them a yield of 8, 9, 10, north of 10%, for that very reason, that if it doesn't work out as intended, it doesn't derail them. There's just enough there where it's additive, but it's just like when you're putting a portfolio together of growth companies. There's enough there that'll be additive, but there's not so much in there where if something goes wrong at the wrong possible time, it doesn't derail you. Right? It's all about balance.
It is.
Even with dividend-paying companies, it's all about balance.
Exactly. And look, even in our dividend equity model, we have 30% of the portfolio allocated towards growth stocks so that the portfolio will track the S&P 500. When the S&P 500 is going up, it'll track that return, and the other 70% is in dividend-yielding companies. So the portfolio gets basically S&P performance with a higher than S&P yield. It yields about 3.75%. So again, in that structure, you're now getting that return. And this is the most important thing, just, going back to our 50-50 allocation. The reason that you need the growth out of your portfolio is that dividends and income from bonds don't adjust for inflation over time. So you need the equity allocation. This is, one big mistake that a lot of investors will also make is they go, well, if I can just lock this in, I'm going to do 100% of my portfolio in bonds. That's great. But in 10 years, you've gotten 4% every year. That's great. But inflation has been eating away at that. So what you need is an equity allocation so that portion grows. And so let's say your stocks are 50% of your portfolio. That stock portion of your portfolio grows to 60%. You then sell 10% of your portfolio in equities, rebalance it back to 50-50. add more bonds, add more whatever else you need, and then that helps that income and increase with inflation over time. So that's why equity components are a very important part of a retirement portfolio to provide that inflation hedge in the future.
Yeah, I mean, still, I still this theme of T-bill and chill is very common still, because rates on T-bills are 4%, a little bit north, depending on where you look on the short end of the curve. You can go out on longer duration bonds and lock in over 4%. So it feels good, right? So now that I wouldn't consider the income stream that T-bills generate. I don't really consider that quote unquote stable. I think that falls more into the fixed category. When somebody says, John, I'm looking for a fixed rate of return. I want it to be predictable. I know exactly what I'm going to get. I don't want any questions about it. This is what I'm going to earn. Hey, let's look at let's look at T-bills, right? But there's a lot of folks now where they're concerned about Fed reducing interest rates before the end of the year, and how likely is that? And maybe these 4% yields aren't going to be around forever. So hey, you know what, John, this T-bill and chill may not work for me because maybe I'm in my early 50s. Mid 50s, what is your runway? I mean, you may have another 30, 35 years of your life. And so to Lance's point, you need to have some allocation to equities, I think, to help fight inflation. But then the question becomes, well, I've got this T-bill portfolio. How do I transition away from this T-bill and chill into something that maybe can provide me some potential longer term growth? Right. Any thoughts on that?
Yeah, you have to do it. There's some things in your portfolio. A lot of people really worry about that transition part.
Yeah.
Sometimes you just have to do it. It's like, hey, I need to start exercising. Well, you can't really ease into exercising. You just have to get up and do it. And it's the same thing with a portfolio. Sometimes you just have to make that demarcation point, say, today, it's the day we're going to make this change.
Yeah, or let's say you have a ladder. Let's say you've built out a T-bill portfolio and you have maturities in there of 3 months, 6 months, 9 months, a year, or maybe a little bit longer, 6 months, 12 months, 18, 24, however you've built your ladder.
Yeah.
As your T-bills start to mature and you get that principal back, you still have some T-bills in the portfolio. The money that gets matured and returned to your account, start using that to get into the market, right?
Absolutely. Just real quick, there's a headline out. I sent it to Brent the other day for today. 45% of American homeowners have regrets about buying their current home. Here's their number one complaint. This is mostly young millennials that have recently gone out and bought houses. Their number one complaint, maintenance costs and hidden fees. Nobody told them you actually have to maintain the property once you buy it. And then there's all these bills that you get, like the homeowners association dues, everything else. It's like, wait, where did all that come from? Nobody told me. I didn't have that when I rented an apartment. This is why I keep telling you, renting an apartment is not a bad thing. Renting a house is not a bad thing. You just pay your monthly bill. That's it. Homeownership is touted by the National Association of Realtors as this great thing.
It's the American dream.
It's not the American dream, but National Association of Realtors touts this as the American dream. So you'll go buy a home and they can make fees and money from you. But renting is not a bad thing. It's a flat fee. And then and my daughter's learning this right now, is sometimes it's cool. It's great when the washer machine goes out or the dishwasher. You just pick up a phone call. Hey, your dishwasher's out. Come fix it, and they come fix it.
So our
you don't have to write a check for it.
Yeah, our oldest just moved to San Antonio, so she's renting an apartment out there, and literally within the first 2 weeks after she moved in, San Antonio had this big storm. Lightning hit the building, fried the dryer. So her unit comes with a washer and dryer, fried the dryer. And I was like, she called me. She's like, Dad, how do I troubleshoot this? I was like, let's check the fuse box. Let's do all this stuff. And nothing worked. So I said, all you need to do is pick up the phone and make a call. Next day, boom, brand new dryer in there. She's like, Dad, that was pretty easy. See? Not bad.
It's not bad.
It's not bad.
I'm trying to convince my kids. Again, the only people pushing people to buy a house is a bunch of people trying to sell you a house.
Trying to sell you one.
Exactly. All right, when we come back, today's topic, I told you we would get into this, is should you let your kids move home after college? We'll talk about why you should or should not. I'm in the should not camp. Surprise. Be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Declare your financial independence from the mainstream financial media and join us for the next RIA Candid Coffee with Danny Ratliff and Lance Roberts, Saturday, June 28th. Know the enemies of your wealth and fight them on your terms. We'll arm you with the information you need. Register today for the Financial Independence Edition of Candid Coffee, Saturday, June 28th with Ratliff and Roberts at realinvestmentadvice.com. Realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right. So the big days come. Your kids graduated college, and there was a big article in Barron's about helping your kids out. They graduated college, and a lot of things we're seeing parents do now is they allow them to move back home. And the thesis is hey, I want to help. They can move back home. They can hang out here at the house while they search for a job. Then they get employed. And they can save up some money, so when they move out, they kind of got their feet under them. It sounds all great in theory. There's some drawbacks to doing that. But before I tell you what the drawbacks are, John, your comments?
I'm right there. I mean, when I saw this article, it was so spot on with what's going on in the penthouse right now, right? Because our daughters, so our oldest will be 25 in October. She just moved out. So she graduated from school 2 years ago. Okay. All right. She came back home and lived with us for about 2 years, and she just was saving money. And so she just went out west. Now she's in San Antonio. Our youngest daughter's 22. She'll be 23 in July. She's going to graduate from college. She's here in Houston. She'll be done later this year in the fall. Okay. And this article specifically talks about, college grads ages 22 to 27. Spot on. I'm right there. Right. And it talks about, the unemployment rate for college grads right now is about 6%, which is actually higher than the unemployment rate for the national average, which is running about 4%, right? Right. So yes, when our youngest graduates this upcoming fall, she's at home right now anyway, because where she goes to school, we don't live too far from it, so she commutes back and forth. So she's already with mom and dad. Okay. But we've already framed discussions around, hey, when you graduate, let's kind of talk through this, and we've already made it well known. Hey, you're welcome to stay, save money, get set up, get on your feet, but moms, dads, you got to talk with your kids about this stuff. There needs to be open communication. So that's kind of my lead in to this. Okay. Yeah. So what's your decision? My decision? Yeah, let them move back home. Hang out? Sure. Yeah, they can come. Yeah, sure. As long as. See, I think it's a terrible idea. Well, but as long as they are additive, in other words, they're not just going to come home and sit, right? They need to go out and they need to work. And we're going to be talking about what are they saving and how much and what are they saving into.
Right.
Roth, right? Roth 401k, et cetera. So get themselves set up, and then
here's why. And
all right,
I got you.
Come on.
It all sounds good,
Yeah.
right? It all sounds good in thesis. Here's the problem with it.
All right.
And this is what I've tried to explain to my kids. It's like,
Yeah.
do not come home after college, because when you do that, right? So I've now allowed my son to come home from college. He's now living in my house.
Yeah.
How big's his search radius for a job? He's living at the house. So he goes, I need to find a job close to the house. So I don't want to drive 2 hours to work to the office and back, right?
Yeah.
So immediately by allowing them to move home, you have shrunk the entire world of job opportunities to your local area. And so now, rather than him coming out of college and saying, hey, I can take a job in Washington, Florida, California, wherever it is, wherever the best prospect is for me to move and be there. If I want to go work for Palantir, wherever it is, then I've shrunk that job search to my local area. Because just human nature, right, is that Dad said I have to get a job. Great, so I'm going to find a job with a company within the Houston area, which is fine. There's some good companies in Houston. I'm not saying that at all. I'm not saying that there's not good jobs in Houston, but all of a sudden I've shrunk their universe of possibilities to one specific geographic area. And so what I want for my kids is, because when your kids are growing up, they have these great ideas like, I want to go live in, my daughter was the best one. She was like, I want to live in Hawaii. I want to live in, every month it was some different city. She'd see something on television. But that was great for me. I was like, that's awesome. You go live wherever you want to live. Go experience the world. Go see that. Because that's what I did after I graduated college. My dad said, you can't come home. So I packed my bags and I moved overseas. And I lived over there for 10 years and, rode trains and worked in, hostels and all kinds of stuff to pay bills and live. But, that gave me a very different perspective of the world. If my dad had allowed me to move back home, which was Friendswood, Texas at the time, that would be my world. And what the experiences are that I have now because of having to go out there and struggle and scrap and save and all these type of things would have been taken out of my life. So that part of that equation's gone when you allow them to move home.
Yeah, and I definitely see the side there. Now, I think it kind of depends too. I think a lot of it depends on kind of where home is. I mean, when I look at Houston, the companies that are here, I mean, there's a location here. I mean, there's several businesses in Houston where they have locations all over the world, right? So let's say you just get your foot in the door with a great employer somewhere here in Houston. There's an opportunity to transfer or move, work hard. I mean, you don't have to necessarily stay in Houston.
No, that's
you
true.
could move or transfer wherever you want to go, and that's why my message to our kids is be proactive. No matter what role you're in or what you're doing, be proactive. And go out there and go get it. Right. So I think I hear what you're saying. I think a lot of it depends kind of where home is. But what I found interesting about the article as I was going through this article with Barron's, of the parents who let their kids come back home, move back in after college, 38% of moms and dads said, yeah, this is really taxing on our own retirement plans. 38% of them were complaining. But then the kids, the young adults who moved homes, when they were interviewed, 60% said, well, mom and dad, they've never talked to me about it. They had no idea. So there's no communication going on.
No, parents are never going to tell their kids, hey, you're ruining my retirement, please move out. They're not going to do that. And so, this is kind of the other side of it as well, is that, you think you're doing your kids a favor by allowing them to come home, because when they move home, what are you doing? You're still, saying, hey, live here and go get a job and all this. They're not paying rent. They're not having to pay for food. They're not having to pay for, whatever else expense-wise. You're still paying for their insurance. You're still paying for their mobile phone. So they're not learning the importance. And it's great. Like you said, hey, I'm going to get them to save money and put it in a Roth. That's awesome.
Sure.
But they're not learning how to budget and balance. And maybe not in your case, but in
general.
In general, they're not learning how to manage a household and have that experience of, hey, I've only got so much money to live on. I can't afford this iPhone. I'm going to have to go get me a Cricket plan with a flip phone for right now because that's all I can afford.
Right.
And, those challenges are the biggest builders, kind of the building blocks of building good, solid financial foundations, is that you've got to struggle
in order to learn the importance of managing money.
Well, you're right, because I like with us, with our girls. I mean, they're
girls.
They're girls. The girls, right?
They
contribute to the pot financially. They contribute to the pot. So they understand that. Hey, look, yeah, mom and dad cover things, but the girls they need to contribute to the pot because they got to learn the basics around what is a budget, how much money do I have coming in, what can I reasonably afford. Just like with our oldest, when she was looking at apartments, she's like, Dad, I know I can afford this. I can't afford this, so I'm not even going to go look at it. Here's the price range that I know I can afford, and this works for my budget. Great. And we just looked at it. She ran it. She spearheaded the whole thing. I just blessed it, and I said, yep, this makes sense, right? But not a lot of families do that. And trust me, we got our own issues to work on. Trust me, it's not perfect at the penthouse. That's not what I'm saying. We got our own issues that we're working on, right? But you're right.
Yeah.
You gotta be able to teach your kids how to function out there. So I can see where if you just let them move back home and that's it, there's no skin in the game. There's no conversations around this. They're not helping to contribute to groceries, whatever it might be. That's an issue.
Yep.
Yeah.
No, look, like I said, my daughter's got her first apartment. She lives in Austin. She just got out of school, and I was like, don't come home. So she went and got a job, and she's living outside of Austin, and she was looking at apartments and stuff. And she goes, I can't afford to live in Austin. I'm like, yeah, you can't.
Yeah.
You cannot afford to live in Austin. So she's now having to live in Georgetown and commute into work. But she's figuring it out, and this also kind of goes back to young millennials that like, I want to buy a house. It's like, you can afford to buy a house. There's 500,000 more sellers right now than buyers. There's a lot of really good opportunities to buy a house right now in the market, but you're not going to be able to buy a house probably where you want to buy the house. You're not going to be able to buy the upscale neighborhoods. You're not going to be able to do, have the, 4-bedroom, 2-car garage with a pool in the backyard. No, you can't afford that. But there's plenty of houses. If you're willing to buy a starter home and fix it up, do the work, turn it into a rental property, it's a great way to get started in home ownership and start building a good, solid foundation. Because when you move out of that house, you either sell it, take the capital, roll it over into your next house, or turn it into a rental, right? Which becomes an asset for you as well. So, again, it's all about just understanding financial foundations and getting your priorities in order. The problem is that and I think this is the biggest challenge for me when I talk to people that have allowed their kids to move back in. 80% of the time, it's not a positive experience because the kids don't learn that financial grounding. It's just, hey, live here for free until you get yourself set up, and then they move out and everything goes to, kind of goes to hell in a handbasket because they didn't learn those processes while they were in the house.
Yeah, or hey, look, I know you want to take care of your kids, especially if they get into some sort of financial trouble, whatever that might be. But then there comes a point where you have to kind of let them figure it out.
Yep.
Because there's been too many times where I visited with some moms and dads where their kids are over 40 and still being bailed out of making bad financial decisions.
And
it's like,
debt,
wait,
whatever it is.
It's like now this really is derailing your retirement plan. It's like we need to have a hard conversation here. If you want me to join the call, I'm happy to.
Yeah.
Right?
At some point, you just got to let them. You got to let them just figure it out. We all did it. If you're listening to this channel, probably when you were growing up, you went through this hard stuff. It hasn't changed for anybody. It's still just as hard as it was back then, and somehow magically you survived it. They will too, right? Take the reins off. Let them run a bit. It's okay. All right. Wraps up the show today, John. Thanks so much.
You bet.
All right. Be back tomorrow with Danny Ratliff. Pick up on the markets. Futures pointing a little bit lower this morning. Not dramatically, but we'll see how the day plays out. See you back here tomorrow morning.